let's go to talk about this and its effect on the markets. We can just look no further than the futures. At least this morning, not a whole lot of flux. We're closing in on 3,200 on the S&P. The last time a U.S. president was impeached was President Clinton, as you recall, back in December of 1998. The impeachment process lasted a couple of months. The markets pretty much took it in stride, rising slightly when all was said and done. Joining us to discuss the possible market impact this time around is Hans Olsen, Chief Investment Officer at Fiduciary Trust Company, and here on set, Sarat Sethi, Managing Partner and Portfolio Manager at Douglas C. Lane and Associates. Sarat is also a CNBC contributor. Sarat, the operative term there was when it was all said and done, the market rose slightly back in 19, and there were other things happening. We had the tech boom and everything, dot-com boom. But this time around, it's not rising slightly when it was all said and done. It's been setting a series of new highs right in the midst of the entire process.
It has, and I think last time also the Fed had cut rates 3 times. We've had 3 times right now. The economy is going to drive this. I mean, the impeachment's important. Don't take anything away from it. But I think the economy, earnings are really going to drive what the market's going to do, at least for the next 12 to 18 months. And our view is earnings are going to be strong. The question is, do they catch up to the multiples that we've had, because we've had a nice multiple expansion. And I think the way we've got to set up in terms of where the economy is, with employment, interest rates, and some type of global GDP growth, the stock market is ready to rise from here.
It's important, but is it important to both sides in that it just bolsters the tribalism or the whatever corner you're in? It seems to give you, I don't know, more. It energizes both sides.
And unfortunately, you are going to.
Who wins that? Do you think?
I think the market is going to win out here, and
the stock market will win out in terms of going higher. You mean?
I do believe so, because the stock market's going to rise because of what's happening in our economy. And our economy is actually doing okay.
And it doesn't matter what happens with impeachment in the House or the Senate?
Well, no, it is important what's happening, but we have to see whether, what happens in the Senate. And all this could be a lot of noise, but I think it will cause some volatility. But at the end of the day, if things are going the way we think they are, which is that the Senate won't do anything, the market's really going to go forward with some noise along the way, especially now that you've got elections coming up, and you have to see kind of what the other side says too.
Good that for Democrats that it is not 2020 yet, but they're getting it in under the wire. But because if it was, I think if it was 2 weeks, 3 weeks later, it would be, November is around the corner.
It is.
So you can still sort of say, look, we had to do this, Constitution, all that. But it's still 2019. If it was 2020, I really do think even more people would say, we're going to litigate this at the ballot box.
Right. I think
why put us through this?
Exactly. So, but then if what we see is right now, markets will react to this, and if nothing really comes out of this, which it could, but if it doesn't, you could see the market have some more legs from here. And I think
because you think that President Trump will become stronger and will therefore be a stronger candidate in the fall.
Yes.
And therefore the markets will like that more than they will like Elizabeth Warren or Bernie Sanders.
Exactly. I think the policies in place, again, not talking politics, the policies in place economically have fared pretty well so far.
All right, let's get to Hans. Hans, where are you on this?
Opinions, Joe, and the
Let's
opinions
start over.
that we're seeing.
I didn't hear you at the beginning. What'd you say, Hans? Your mic was on.
I think markets make opinions, and what we're seeing in the opinion polls, the people have made up their minds on it, and we see it confirmed in the market. So I think impeachment, as far as investors are concerned, one, it's priced, and two, it's basically yesterday's news. I think people were expecting an impeachment. They're going to get it, and it goes nowhere in the Senate. And when we pivot right back to trade, earnings, and the like.
And for 2020, if you were to look at 2020 and not be talking about impeachment, what do those things look like for you? Earnings, trade, global growth. How does that look?
Yeah, so that's where it gets much more interesting, because I think the big issues that investors are going to have to contend with in 2020, one, what will the earnings be? I expect they're going to be probably somewhere on the order of 4 to 6%. But the question really is, what do you pay for those earnings? And as Sarat observed, people have to pay more for any quantum of earnings. The bigger thing, I think, in 2020 that we're likely to see is a reversal in a strong dollar regime. Now, if this happens, that's going to help large cap stocks. but it's also going to help the long-suffering emerging market stocks as well as European stocks. And I think Europe is probably the story in 2020 because we've got new political leadership there with a reform agenda. So it gets interesting in the new year.
So why would the dollar weaken? Because the rest of the world are our advantage, and the capital flows into the United States sort of subside a little because the rest of the world starts recovering, and the dollar on a relative basis becomes weaker.
It's a bit of the reverse. So I think what we're seeing is the growth rate of the United States. So the growth rate differentials are coming down relative from the United States relative to the rest of the world. That's certainly happening in the interest rate differentials, which typically uphold the dollar, underpin the dollar. But finally, the amount of new debt that we're hitting the market with, combine that with QE4, is it the version 4 right now? Whenever you get that sort of confluence of events all happening, that is all dollar negative.
Okay. But I just don't see rates going up anytime soon on the continent, in Europe, and I don't see them going down here, so I don't see why that doesn't seem to follow, does it?
The bigger issue is the quantitative easing is going on again.
Okay.
So the Fed is once again expanding its balance sheet, and the government is issuing a lot more debt.
Okay. You agree with that, Sarat? A weaker dollar?
I'm not sure about the dollar, but what I think is you're going to see a rotation because of where valuations are. When you're trading at the high end of kind of where the S&P is, within the market you could see a rotation, and value, which has just underperformed for years and has some really good areas in it, if you think of the financials in there, and even a beaten down sector like energy that has potential going forward. I think investors are going to look to see, well, the market might even go up a few points, but where am I going to get the biggest bang for my buck? And the earnings growth, I think, we find is going to be better in financials. It's going to be in select industrials. It's going to be in energy stocks. It's not going to be in the same go-to, tech stocks, which I don't think you don't have to hold. You can barbell, but I think you should put a majority of your portfolio more on the value side because that's where the true, I think, upside is going to be.
And inflation, in your view, for 2020?
Pretty muted, I think, given how much money we're printing, and really you don't have any price pressures here or elsewhere, so much capacity on. So you really have to look at companies that are going to grow top line, but then have really some leverage on the earnings side.
The inflation hawks, Hans, through QE 1, 2, and 3, they were never, it never came home to roost for some reason. I mean, it's global, but this time around, do you think, if you see a weak dollar and QE4, does that engender inflation?
Well, we've seen wages push up, tightness in the labor market. If you look at sort of the sticky numbers that I think the Cleveland Fed puts out, those have all pushed higher. I just don't think it matters because the Fed has told us that they're going to let it run hot for a bit. And I don't know if 3% is hot, but they're going to let it run above their target for a bit. So at the end of the day, I think they can live with that.